welcome to a special edition of SB Talks. Today, I want to introduce you all to our Chief Investment Officer-elect, Nick Ryder. Nick will formally take over the reins from Ashley Owen effective 1 April, and today I want you all to get an opportunity to meet Nick and find out a little bit about his background. Welcome.
Thank you.
So Nick, why don't you start off by letting our clients and listeners know a little bit more about your background?
Yeah, so most recently I was a senior investment strategist at Commonwealth Bank in their private banking division for a couple of years. Before that, in a similar role at JB Weir, so an investment strategist for around 5 years. And really, you know, what is the role of an investment strategist? It's very much high-level asset allocation, portfolio construction, talking and writing to clients about what's going on in the world, working out how to tilt their portfolios from an asset allocation perspective. And yeah, that's pretty much it. And before that, I was with NAB Private Wealth, which is the private banking arm of National Australia Bank.
And cast your eyes a little bit further back, so that you've talked about probably the last 10, 15 years. What's your background? What was your origins in the finance world?
Yeah, so I started, going right back to being a graduate at Arthur Andersen, a firm that no longer exists, as an accountant and in their corporate finance division, actually. So I specialised in sort of valuing companies and doing corporate advisory. I then moved into the investment banking world with a firm called County Out West, where I did the same thing, IPOs, mergers and acquisitions for about 4 years. And then got into the alternative investment space, so managing money for people. Firstly, in event-driven investing, which is investing in companies going through takeovers and IPOs. And then subsequently, we ran a fund of hedge funds where we allocated money to different hedge fund managers around the world.
So do you mind actually just going a little bit deeper and just explain to the listeners that broad category of alternative investments, what sits in there and why it's relevant to portfolios?
Yeah, it's something of a catch-all term. Alternative investments, basically anything that isn't traditional. And when people think about traditional investments, they think about shares and bonds and cash and probably property. Anything that doesn't sort of fit neatly into that category is often lumped in with alternative investments. But more specifically, it's the broad categories of alternative investments: private equity and venture capital, private credit potentially in there, hedge funds, as I mentioned. I specialised in those going right back over time, and they're basically funds that trade shares and bonds, etc., but try not to be impacted by market movements, trying to generate alpha, if you like.
Less benchmark aware in terms of their performance. Less benchmark
aware. Other categories of alternative investments are managed futures, potentially some styles of real estate investing, such as very aggressive development and value add and opportunistic. So there's a whole category of styles that potentially belong in alternative investments.
And some of them potentially very relevant to our clients and their portfolios, and some of them certainly potentially not. There's been a lot of interest and discussion around the key areas of private equity and private credit in the last few years, in particular with volatilities in markets. Areas that you've allocated to previously in portfolios?
Yeah, so in my prior roles, we did allocate to private credit and private equity and private infrastructure. They were sort of the three main categories. We also had hedge funds. They're probably in the portfolios for a lot longer. Those strategies, but more recently private credit and private equity.
Do you mind sharing with the listeners, I guess, examples of what could be private equity type investments versus private credit type investments?
Yeah, so the private equity investments we made were basically tended to be larger companies, mid to large companies that were being taken private. So often they were on the stock exchange and then taken private by a private equity firm with a view to improving the investment, the business's performance.
The turnaround story.
Turnaround story. Often they argue that if management's too focused on being a listed company, they're very focused on short-term results, and taking the company private allows them to build, things over a longer term. So that's generally private equity, and there's different categories of private equity. So there's buyouts, as I mentioned, where they're taking companies private often or buying them from other private owners. There's also growth equity, which is basically sort of mid-stage companies that need capital to grow, and then there's early stage, more venture capital type investments. In private credit, there's a whole lot of different strategies. Generally, the bigger ones are lending to businesses, so privately negotiated loans provided by a private credit manager to a business, and they might be, a 5-year loan that pays an interest rate that might be better than what the firm could get, or maybe the firm can't get capital from a bank, so they might
from a traditional institution.
Yeah, they might be able to get it from a traditional institutional or banking source, so they go to a private capital firm often to get that.
So often a source of yield, particularly of interest over recent years when interest rates were so low, albeit they're rapidly picking up again.
That's right. Yes.
Do you mind, when you talked about your prior roles there and the variety of responsibilities you had, do you mind just sharing at a high level the role you see of asset allocation in portfolios, both in terms of strategic asset allocation and tactical?
Yeah, so for me, that's really the starting point. Asset allocation is the main driver of whether clients often achieve their objectives or don't achieve their objectives. It's the main driver of the risk in their portfolio. There was a very well-regarded research study by BHB, it was called. I can't remember the initials of the people that wrote it, but it's widely cited as saying that the asset allocation explains essentially 90% of the portfolio's returns or variability in returns specifically. And therefore, selecting a manager or selecting an individual stock is actually a very small contributor to the overall returns. It's whether you're in equities, bonds, property, cash. It's that mix.
It's the big calls and getting the big calls right.
It is. And so that's always been my starting position is making sure we get that right for clients. And the other thing I think about asset allocation is really diversification is the only free lunch in the investment world, where if you blend asset classes that don't move together, you actually do get a better risk-adjusted return.
You want to elaborate on that a little bit further? I think that's going to be a separate podcast in itself, but and we certainly have an event coming up for clients in April. But talk to us about how that is in practice rather than theory.
Yeah, so traditionally, let's just take a simple 60-40 portfolio, 60% equities, 40% bonds. That's what they call the traditional balanced portfolio. And basically what tends to happen is when investors are fearful and they're selling equities, they're moving into the risk-free asset, which is a long-dated government bond. And so those two assets often move in the opposite directions. And so by blending them in a portfolio, you're creating a smoother return.
Hypothetically, the one big call out there, and this is probably where it comes down to things like that might be your strategic asset allocation, but this is where tactical allocation comes into play. And we've seen over the last 12, 14 months where long-dated bonds have been impacted. How do you think about that from a portfolio construction perspective?
Yeah, so the strategic asset allocation is meant to be a long-term average holding to the different asset classes. Now, obviously, over the time and through the business cycle, we try and adjust those, and we call it dynamic asset allocation. So if risks look asymmetric to us, or valuations look expensive, or there are opportunities in certain asset classes, we'll tilt the strategic asset allocation to try and add value or reduce risk in client portfolios. So 2022 was an example where actually bonds and equities moved together. They both fell.
Negatively.
And that is quite a rare occurrence. The last time that really happened was 1994. But that's why we build diversified portfolios. We take a long-term view, and we also, as I mentioned, try and trim the sails, if you like, with the dynamic asset allocation.
Do dynamic things like adding floating rate debt or adding alternatives into portfolio to help manage the downside implications there. In terms of portfolio construction, also the importance of we think of the bucketing approach, ability of setting aside your cash flow for the next 6, 12, 24 months, such that you can then allow the portfolio to get on and do its job over the medium to longer term as well.
Yeah, I mean, that's quite common for clients, is to create buckets, so different asset allocations for different objectives. It's like having assets to meet different liabilities or different objectives. So that is quite common that I've seen in prior roles.
Now, I'm conscious that today is really more of an introduction, but I couldn't possibly do the podcast without asking you just at a very high level your views in the world. In particular, the last 48, 72 hours have been dominated by news out of the United States and essentially a run on Silicon Valley Bank with the FDIC needing to step in there. Should we be concerned?
No, I don't think so. When we look at the issues surrounding Silicon Valley Bank and the Signature Bank, which was the other one in New York, they were very specific issues that got them into trouble. And so I don't think there's any sort of systemic risk. In the case of Silicon Valley Bank, you had a bank that basically taken a lot of deposits from venture capital firms. And with the rise in interest rates and people, I guess more cautious, the amount of money flowing to venture capital dried up. In fact, those companies were actually pulling money out to fund their operations. And so that was a very unique scenario. Fortunately, the Federal Reserve, US Treasury and FDIC stepped in over the weekend to basically sort of allow banks that had maybe lost money on their bond portfolio to finance those at the original cost. So any mark-to-market losses wouldn't be necessarily absorbed by those banks. So it's quite a good move.
And essentially stood behind, not just the previously insured depositors, but all depositors at Silicon Valley Bank, which really capped the contagion risk, albeit still a bit of speculation swirling in terms of what does this mean for other regional and non-core banks.
Yes, I mean, I think as from the research I've read, there aren't any other banks that really have a large percentage of uninsured depositors, which Silicon Valley Bank had. Most have a wide spread of depositors, including retail depositors.
Yeah, so worth clarifying for the listeners, that's because the cap on the insurance was $250,000 US, so most balances are significantly below that, but because of the nature of Silicon Valley and the venture and the big balances held there, that was quite unique, as you point out.
Yeah, quite unique. So they had a lot of uninsured deposits, deposits over $250,000. So that was unique. Most other banks don't have the same deposit mix. And the other thing with Silicon Valley Bank is they didn't have their asset side of their balance sheet wasn't traditional loans, it was mainly US government securities, which lost value due to the rise in interest rates. And so most other regional banks actually do make traditional loans. They might still have some government securities, but now with those measures I talked about over the weekend with the FDIC, etc., that should reassure investors, so you won't get hopefully a run.
A succession of runs.
Or a succession of runs on regional banks.
And I guess that's quite a micro current topic, but your views more broadly in terms of the world and where we sit at this point in the cycle?
Yeah, I think, we're starting to see some early signs of inflation coming down, which is good. But I think the central banks still have probably another 6 months of work to do before they top out in terms of interest rates. With the recent issues with Silicon Valley Bank, maybe that gets pushed back a little bit, so they'll be more focused on financial stability risks.
And you think that could see them maybe just not go quite as hard in the short term?
Yes, that's right. Yeah. I think what I'm seeing is a lot of people have dialed back their rate hike expectations, even in Australia actually, over the last week. So we'll have to see how that plays out. But I think the longer term theme is still one where inflation is a bit of a concern, and that that does have issues around possible recession risks if central banks go too hard. So I think it's still
the narrow path to the soft landing.
Absolutely
remains a narrow path.
Absolutely, and we're not through the woods yet. So I think it's still quite a challenging time. That said, everything's well known, so I think there's not really anything that's sort of surprising. And so broadly, I'd be neutral in equities, slightly underweight in fixed interest. and probably overweight in alternative investments is how I'd be positioned at the moment.
And how do you see equity valuations at present, both sort of locally and offshore? And there has been a reasonable amount of modest recovery, let's say, in this year, albeit a bit of a seesaw action.
Yeah, I mean, February's probably been a bit more of a challenging month, but I'd say valuations are probably fair. I mean, it depends which market we're talking about. The US is still quite expensive relative to history and relative to where bond yields are. Australia, Europe, Japan, some of those other countries are a bit cheaper. So it varies. I wouldn't say markets are screamingly cheap. And if we do go into recession, then typically the trough multiple is a lot lower and the earnings are a lot lower. So there'd be some decent downside if we did go into a recession.
Deep recession there. Question that I know that will be on many of our clients' minds is, should we be expecting anything significant in terms of 1 April you coming in, taking over portfolios,
Yeah, no, I don't think there'll be any radical changes straight up. I think it's worth just doing a review of the strategic asset allocation. So I'll be working with our asset consultants, Jana, to look at all the portfolios and say, are these the best portfolios that we can have, particularly if we're going into an environment where inflation might be slightly different to what it was in the past. So I think it's worth doing a review around that. I have some views around currency hedging that I've had for a while. I think the Aussie dollar is a great diversifier, and maybe we'd be changing our currency hedging policy. So some things like that. I also want to tighten up some of the analytics so that we have a better handle on where the risks are in the portfolio. So there's making sure there's no unintended risks that we're taking on. So that's sort of not necessarily a portfolio change, but certainly a priority in terms of just getting a handle
and just how you think about portfolio construction and obviously risk management and downside.
Yeah.
And worth highlighting as well that we will have a client event booked in for the in April, and you can expect to receive a save the date for that in the week ahead, because we'll have a chance to hear from Nick. No doubt there'll be a few more data points in terms of inflation and interest rates, and hopefully no more Silicon Valley banks between here and then. But thank you very much.
Thanks.
Great to have you speaking to our clients and listeners for the first time, and welcome, Nick. It's great to have you aboard.
Yeah, thanks, Vincent. It's great to be here.
Thank you.